Hey guys, my name is Eric Wilson, and today we're going to be talking about diversifying your private equity real estate investments. And I think this is a great topic because I think it's so easy for people to look at their portfolio and say, okay, I'm invested in stocks and bonds currently. I want to add real estate to my overall portfolio. They go out and they find a syndicator or they look at a fund and they invest in that one particular asset or that one fund, and they say, great, I now have real estate exposure to my portfolio. When the reality is that real estate is a massive asset class, and there are so many ways to diversify within it. You wouldn't invest in one stock and say, I have exposure to the stock market. You want a range of different stocks in different sectors. The same thing applies to real estate. If you look at companies or some funds like the Yale Endowment, for example, they invest in stocks, bonds, cash, real estate, venture capital, private equity, natural resources, infrastructure. They invest in a ton of different asset classes for their portfolio because they understand the concept of portfolio theory, which is to have uncorrelated assets. So when different times in the market, if one asset is down, you have other assets that are in your portfolio that are carrying the portfolio up. Individual investors can apply a lot of the same concepts in portfolio theory with less capital, but still the same concepts apply. So a lot of investors understand now the old 60-40 portfolio of 60% stocks and 40% bonds. That's dead. That's been dead for a while. Investors are branching out. Investors are adding things like real estate to their overall portfolio. Investors are looking for that portfolio theory, diversification to carry their portfolio through downtimes. We have a lot of investors who are very exposed to the stock market, and the stock market was down 19%. The S&P 500 was down 19% in 2022. On the other side of their portfolio, they have real estate exposure. They have some core assets that are income producing, and it was a great year for their core assets. The rent growth was still solid, occupancy was high, so they didn't have to dip into their stock investments for capital that they needed because they had income coming in from their real estate investments. So that's the concept of why people would add real estate in the first place to their portfolio. But investing in real estate by itself in one property isn't diversified. So when it comes to diversification within real estate, I like to think about 3 different ways that you can diversify. You can diversify by investing in different property types, different locations, so geographical diversification, and then by different strategies. When you're investing in real estate, you have a lot of different property types that you can invest in. You have multifamily, you have retail, hospitality, you have infrastructure, you have office. For example, you have self-storage. And if you're investing in just one particular asset class, you're not very diversified within your real estate allocation of your portfolio. Think, for example, if you were 100% allocated, you had one investment and you invested in an office building, and something happens like the pandemic and people are no longer in that office building. That office building takes a hit, it's not performing as well. That's major to your real estate allocation. So now the real estate part of your portfolio just took a massive hit. If that's at the same time that the stock market's taking a hit, you see where I'm going. You're not achieving your goal of diversification. Likewise, geographically diversified, if you're only invested into one particular area, say all of your investments, they're diversified, they're in office, they're in multifamily, they're in self-storage, but they're in one location, and that location takes, let's say a natural disaster occurs, and those properties experience, the fallout of that natural disaster, your portfolio takes a massive hit. So if you had, the same sort of allocation to office, retail, multifamily across the asset types, and then in different locations in the Carolinas, in Florida, in Texas, you'd be mitigating the risk of one particular location taking a hit for whatever reason. People are moving away from this region. People are moving towards this region. You see where I'm going with the diversification. So you've got different property types in different locations, but then you also want different strategies. So we've talked about having core investments, value add investments, opportunistic investments, a good blend of income producing properties, a good blend of growth properties, is another way to add that stabilization to your portfolio. So you don't want all development projects in your portfolio. Maybe you do, but I wouldn't say it's a great idea to have all development projects. You're not gonna have that income coming in if a downturn happens. You're very exposed to the market cycles when you're doing a development deal. So having a good balance of income producing properties in different property types, in different locations, plus growth stocks, growth properties in different locations, in different property types would be a great way to diversify your private real estate investments. So those are the basic ideas of diversifying your private real estate investments. You can do this yourself by picking individual properties to do, to figure out how the right mix for your portfolio. You can invest in a different type of different real estate funds. I wouldn't say investing in one fund by itself is diversified, but investing in a range of funds with different strategies, different property types, in different locations, and with different managers is another one. So we've got a bonus diversification strategy in here. If you're investing with funds, if you're investing with syndications, investing with a different manager in your investments is a great idea. It's a great way to mitigate that manager risk. If one manager passes away and they were, a sole operator, they didn't have great partners to step in, that could be detrimental to your investments. If you're investing with different companies, one company goes under, and that's where all of your investments are. Real estate is definitely an industry where you want to work with different operators, different companies. You want to have that diversification. So a little bonus in there for you guys. But that is the general basics of diversification strategy for private real estate. I hope you guys enjoyed this video. Please like and subscribe, and I'll see you guys in the next video.